So in the first lecture, I suggested that we could really think of a firm's stockholders' equity section comprising uh, essentially two primary components, which would be the paid-in capital accounts, our common stock, our preferred stock, all of our APIC, those sort of accounts all flow into the paid-in capital accounts. And then we can also have this other substantial piece of equity, which is retained earnings. And retained earnings is different in that this is a direct investment in the firm. So this is from, this is from firm financing, where we're issuing stock, repurchasing stock. This all counts as financing activity. And then this is a reinvestment. So it's more of an indirect investment of the firm into itself. Because remember, if you do, retained earnings is equal to all of the income that has been earned by the firm since its incorporation to the present day, less any dividends that have been paid out of the firm from those earnings. And so it's the internally generated funds not paid out. So what goes into this measure? Of course, net income goes into the measure, as we talked about here. A lot of dividends, most dividends, in fact, as we'll see throughout the different examples that we have. Treasury stock transactions can sometimes, remember this will happen when our APIC treasury account is depleted. And then if you go into the topics of discovering prior accounting errors or changing accounting principle, these two items will affect the overall retained earnings of the firm. We actually make beginning of the period adjustments net of tax. So for example, if we found an error 5 years ago, we still want to adjust the retained earnings this period at the beginning for the results of that error. Because we're talking about retained earnings, we want to make sure it's net of tax. We're putting it straight into retained earnings. And all income effects that we put into retained earnings are net of tax. And we apply it at the beginning of the period. The change in accounting principle is a little bit more technical. Essentially, this is when we switch from one accounting method to another accounting method. We have to go back and assess the effect of that change since our incorporation, and then bring the effect of that change in terms of the effect of net income forward, accumulating that effect over the years from the incorporation to the present day. That's a lot of stuff, a lot of bookkeeping adjustments that you have to do in order to figure out for a company that has been in business for quite some time. But again, these changes, this cumulative change resulting from a change in accounting principle would be applied net of tax and at the beginning of the period. And then sometimes we'll have what we call appropriations. And appropriations are just reclassifications of retained earnings. And it doesn't result in a change in the overall value. It just puts them in a separate compartment in terms of restricting them from dividend payment. Dividends have to be paid from unappropriated retained earnings. And so certain covenants will set appropriations on a firm's retained earnings, certain debt covenants, that is, so that the firm is not paying out retained earnings in excess and then not able to make periodic interest payments to the creditors of the firm. So that's retained earnings in a nutshell. We'll now kind of delve into dividends. Most about net income, and then we'll talk a little bit more about other transactions that could occur. Ordinary cash dividends are pretty straightforward in terms of recording them. They're paid typically quarterly from a company to its shareholders of record. Now remember, there's not a whole lot of firms that pay dividends these days. The older firms tend to. Firms with limited growth options start to pay out cash dividends, but younger firms are very cash hungry and typically won't want to pay out their earnings. They're going to want to keep it in order to expand the firm, expand in operations. typically have a consistent stream of dividends whenever we are declaring a dividend, simply because dividends tend to be sticky. If you recall that discussion from the first lecture, where repurchase options have become much more popular, a much more popular vehicle to return cash to shareholders, because they don't require the obligation, the repeating obligation that dividends typically impose on a firm. Once a dividend is declared, investors expect it from period to period, and if they fail to deliver, the investors can't put the firm to bankruptcy. However, they will drive down the stock price to some degree if the firm policy is changed, especially if it's changed to a large magnitude. So there's a few dates in declaring a dividend. The date of declaration is when the legality begins, and so on this date, we actually record the payable. You can record it to dividends first as a debit if you care to, and then you would have dividends payable. Some will just, instead of debiting dividends, will just debit retained earnings directly. Because remember, even if you do dividends, then you're going to have to close out the dividends account and then debit retained earnings. And so the idea of just going straight to retained earnings is avoiding the middleman because of the closing entry involved in bringing out the dividends account. On the day of record, this is the day that the shareholders are determined who will be paid. So we go through our stock files, determine who owns stock in our company, where we're going to mail the checks, but there is no journal entry required. So it's just the day that we record who we owe money to, who we make the checks out to, but there's no change in the financial status of the firm. On the day of payment, of course, then we have a cash flow, and so we'll pay cash for the amount of the dividend declared, and that is when we can reduce our liability account. And so you should know, of course, the different days, what they signify, and then how we record them. Of course, remember, this is when the cash flow effect of the dividend occurs, and it would be considered a financing cash flow effect. And the day that we record the reduction to retained earnings is the day of declaration, because the firm actually becomes responsible legally for it. We record a liability, and then again, we can either record dividends or straight to retained earnings. There is no net income effect to dividends. Remember that. They do not show up on the income statement. So looking at this example, we have on February 24th, 2010, Boulder Rings declared a regular quarterly dividend of 44 cents per common share to shareholders that they had on record on March 1st, 2010. The company had 2.4 ending. And they paid the dividend on April 14th, 2010. So now we have to record the necessary journal entries. So on February 24th, 2024, is when we actually have the declaration. And the declaration was a 44-cent dividend to its 2.4 billion outstanding shareholders. And so remember, you want to only record a dividend for outstanding shareholders. We don't pay dividends to our treasury stock. So the shares issued don't matter. And I see a lot of people mess this up, where they'll forget the distinction between outstanding and issued, use the issued number, and wind up with an incorrect answer. And so we have 2.4 times 44 cents. That comes out to 1,056,000. And we can record it to dividends as a debit, and then dividends payable. And then this would be, like I said, closed out to retained earnings at the end of the year. On 3/1/2010, we have no journal entry. Remember, this is just the day of record. So we're just paying it to the people that were holding our stock on March 1st, 2010. So even if someone trades their stock away, say in April, they will still be paid because they were holding it on March 1st. And then on April 14th, we have the payment of the dividend. And so we can reduce our liability and then record the cash flow out of the firm to the shareholders of record on March 1st. So that's the ordinary cash dividend. Then there's a different type of dividend that doesn't occur very often. It's called a liquidating dividend. A liquidating dividend is when a firm is ceasing certain operations, reducing the scope of its operations. Maybe it's phasing out lines of business. It's sort of a downsizing, a permanent downsizing. And as the firm is downsizing, they're cutting off the portion of an investment that was given to them by their shareholders. So the idea is that you had an investment in us that was, say, $1 million. Now we don't need that so much. We're starting to downsize our operations. We'll return 20% of it to you. So this is typically, a pretty large or a substantial percent of the company. So a substantial percent of the contributed capital, which would be in the firm in the form of common stock and APIC common stock. So when they do this, rather than debit retained earnings, we're going to debit an interesting account, which makes sense from the discussion here, right? We're going to actually return the money to their shareholders and credit cash for that amount. So a dividend is sort of a return on the investment, right? We're keeping your investment. Here's a percent back in the form of a dividend. Whereas this is a return of the investment. We're not keeping your money and returning it by continuing to grow our operations. We're actually shutting down operations. And then so here's a chunk of what you gave us in the beginning back. Right? So that's why the accounting treatment is a little bit different here. There's no effect to retained earnings, but again, APIC common stock is debited because we're reducing it in light of the fact that we're returning capital to our shareholders through the liquidation of the firm. Property dividends are dividends that are going to be paid in assets other than cash. So for example, investments in securities can be paid, fixed assets could be paid. The most common is the idea of trading shares that are in your investment portfolio and distributing those as a dividend to your shareholders rather than cash. So whatever it may be, whatever the asset is, or whatever property you are providing to your shareholders in exchange for cash, we're going to want to record the fair value of the assets that we're distributing. So the first part is whenever the dividend is declared, we want to mark the asset to market at the date of declaration. That's when you become legally liable for the amount that you are distributing to the person that is your shareholder. So then you record the payable on that date, and then finally you record the distribution on the date of payment, the date of distribution. So looking at this example, we have a company that declares dividends in the shares of ABC. They're currently valued at $130,000, but are carried at $100,000. So this is the book value of these shares. According to the company's books, this is the fair market value on the day of declaration. The dividend was declared in August, is payable in November to shareholders of record on September 15th. So on August 1st is when we become legally liable for this, and this is when we want to actually record the fair market value of these securities. So we have some equity securities, and in this case, typically what we'd want to do is, if you recall, debit the security fair value adjustment account. I wouldn't mind if you had just debited the equity security account directly, even though that's not technically correct, but remember that's how we do it. An unrealized gain on this item for $30,000. So this is for the equity securities. And I didn't say, since they're marketable, tends to be another buzzword for trading securities. So we have to record the mark to market. We also need to record the amount of the dividend. Which in this case is the full value, not just the marked to market portion. Because November 1st is just the day of record, I'm sorry, because September 15th is the day of record, there's no journal entry necessary. And then we pay it on November 1st, and we would pay it instead of cash, of course, crediting cash. We'll record a credit to our marketable equity security account. All right. We would credit the security fair value adjustment account to get rid of that equity security. We would credit itself. And then, of course, the only other thing that's different or distinct in this case is that we have a net income effect simply because we recorded a gain to the equity security when we declared it. The next type of dividend that can be paid is a stock dividend. And a stock dividend is when the firm, rather than returning cash to the shareholders, obviously wants to record an increase in the amount of stock that is outstanding. So they're pretty arbitrary in terms of defining what's large and what's small. Anywhere from 20 to 25% of the shares outstanding, less than that amount, is going to be a small stock dividend. And then anything over that amount is going to be a large stock dividend. You can argue somewhat between these two classifications, especially in this threshold. Conservative accounting treatment would suggest that we want to take that as the amount of the small stock dividend, just because small, as you'll see, small stock dividends have a more pronounced effect on retained earnings as of dividend. Okay. We also have stock splits, of course, which is another form. There's sort of I kind of think of them as a stock dividend in disguise. And I'll describe what I mean by that in just a moment. So a small stock dividend is going to provide a reduction to retained earnings equal to the market value of the shares. The intuition is that small stock dividends are typically viewed by investors as extra cash dividends. So they're going to take those extra shares and then cash them in. That's why the idea is to record them at market value, because to the owner, this will be sold, most likely on the market, to get some cash. So when we record that dividend, we record it at the market value. Large stock dividends, on the other hand, are reducing retained earnings equal to the par value of the shares. They're typically not viewed. Once shareholders get an extra 50% on the shares they already have, they're not thinking about cashing that in. More likely, they're thinking about expanding their ownership of the company. Right? A lot of times, they could be used to just lower the per share price of the stock. And so if there's a liquidity option, a liquidity issue in terms of a low trading volume, maybe the price of the stock is too much per share. Well, when you increase the number of shares that are available by 50%, this is going to reduce the per share price. They're not viewed as earnings transfers, sort of like small stock dividends are. So there's no market value adjustment. We're not going to cash these in because the stock price will be reduced considerably. It's more of an idea that we are increasing the ownership of our current stockholders to a large degree. Stock splits, like I said, are sort of stock dividends in disguise because they don't require anything in terms of a journal entry. So there's no effect to retained earnings. They just change the par value of the outstanding shares. And then, of course, the price also is split in those terms. So if we have 100% stock dividend, a stock dividend is going to require retained earnings to be reduced by the par value of the shares, while a 2-for-1 stock split, which is the same thing because we're doubling the number of shares, just like 100% stock dividend would double the number of shares, requires no entries at all. And so a stock split has, again, a sort of very admirable attribute to firms because they don't have to reduce retained earnings after they split their stock. So let's look at a couple of these. A company has 100,000 shares of $1 par value outstanding. What happens if they declare a 10% stock dividends, 10% stock dividend when the shares are trading at $20 each? So that's the market price. A 10% stock dividend would increase the number of outstanding shares because there's 100,000 shares currently outstanding. We would get an increase in 10,000 shares outstanding. Because it's a small stock dividend, and again, we want to apply the market price to that new number of shares in order to determine the amount of retained earnings we will need to reduce. In this case, we have $20 per share as the market price times the 10,000, and so that's going to be $200,000 of an effect to retained earnings. When this is declared until it's paid, what we typically will credit is you can credit as dividends to be closed out to retained earnings as we have been, but the credits are to APIC common stock and common stock dividend distributable until it's distributed. So this is on a day of declaration. And then remember here, we're going to want to use the par value on the divs distributable because this will eventually go to common stock. So if we're talking about an increase in 10,000 shares per $1 par value, that's an increase of 10,000. We do increase our APIC common stock right away. And then when it's paid, all we have to do is debit the dividends distributable account and then credit common stock. For a large stock dividend, let's say 50% stock dividend, in this case it would be 50% of the 100,000 shares that are outstanding. Then that is going to be, of course, another 50,000 shares. But since it's a large stock dividend, we are just going to use the par value of the stock in order to record the amount of the effect of the dividend. And so when we record that dividend, we have dividends 50,000. And remember, that's just the amount, the par value of the stock we're distributing. And so with a large stock dividend, there's no effect to APIC common stock. Also, of course, no effect to retained earnings, right? Or I'm sorry, no effect to retained earnings, as there was with the small stock dividend. Here, we're going to have a $200,000 effect to retained earnings. When these are closed out, here we're only going to have a $50,000 effect. I'm going to go ahead and ask you to look over these next cases, case 5, case 6, and case 8. Case 5 will require a little bit of thinking, a little bit of critical thought and execution. Is a much more straightforward, just recording transactions within a corporation that occur with dividends. You'll have to watch the number of shares outstanding when you declare stock dividends. BOSS is also going to be similar to BRC, and the final case will be something that we will talk about in class, certainly, because it presents a unique challenge. Thank you very much.